Well, good afternoon, investors. Welcome to the last bull session in January, January 30th, 2024. My name is Mark Robertson. I am joined here by my dear friend, colleague, and inspiration in investing, Ken Kavula. Good afternoon, sir.
I'm now an inspiration, huh? I finally got old enough to be an inspiration. Okay. Hello,
Well, yeah,
everybody. Glad to be here.
and a magical, magnificent mathematician on top of it.
All
Good
right.
stuff. Kim won't be able to join us, but Matt is in the back room, and you never know when Kevin will stumble into the room. So, greetings to you, Matt. Matt is taunting us with his 70-degree temperatures, and we can certainly respect that. All right,
Yeah,
so
if you might call in from the plane, maybe I'll have to be out in the backyard or maybe in the pool next time.
uh-huh. All right, so what we're up for this week, it is the last leg, it is the bell lap for the Groundhog Challenge, and hence the artwork on the left. I do think it's great that we found a really an appropriate place for that dog with this hanging his head out of the car, Ken.
It's great. It's terrific. Okay. I
And
really like these groundhogs that you've dug up, Mark. They have
these,
some personality to them there.
yeah, these are courtesy of Sean Mace, and
All
he
right.
he tosses this type of thing at us. And Ken and I have not yet made it to Punxsutawney, so there is a chance that there's a little photoshopping going on the right there.
Just a touch.
But someday we'll
Looks
make it
like
there.
that hat is sort of balancing on the point on my head here. So,
Yeah, we had a little trouble with the hats that day. It must have been windy, but yeah, we are going to take a quick look at the Buttonwood portfolio, and Ken is going to talk about some of his favorite stocks. And again, we'll just dive in and take it from there. We do have a roundtable tonight, so we'll try to keep this short and to the point. All right, here's our weekly reminder that Portillo's is not a sponsor of this session, but they should be. And then I gave just a tiny bit of time to In-N-Out Burger because I found it kind of fascinating that they're closing their very first outlet in 76 years. So that's pretty crazy. All right.
I did read a follow-up article about that, Mark, and they indicated they were doing it with a lot of sadness and everything, but it was going to cost them more than the building was worth to bring it up to where it needed to be. So evidently there were some pretty big issues with the actual physical building itself.
Yeah, that and some misbehavior that was going on also in the area. So not a good thing. All right. Here's our standard disclaimer. We're going to talk about stocks in real time. No investment recommendation is intended. This is all about education, demonstration, illustration, and all that sort of stuff. What we are literally doing, and we'll continue it at tonight's roundtable, is sharing ideas and sharing how those ideas are analyzed and deployed in our portfolios from a portfolio design to a portfolio management standpoint. So we are literally leaning on 8 decades of things that we have learned and witnessed, and in many cases lived out with the modern investment club movement. So you'll hear our opinions on that, and then that's it's up to you to do your own homework, please. We'll try to remember to let you know if we own anything in our portfolios. Like for example, I do own a few shares of Portillo's. All right. Tonight's session for the roundtable is at 8:30 Eastern time tonight. It is a webcast that we do monthly, and we've been doing it since 2010. If you'd like to be added to a reminder list for that once a month webcast, send an email to nkavula1@comcast.net, and we'll take care of getting you on that reminder list. If you have any thoughts or suggestions or questions or anything like that, our 2 email addresses are at the bottom. All good, Ken?
All good, Mark.
All right. Here's our weekly slide, which we constantly think about getting rid of but never do. It is a decent guide for just about anybody to look at the condition of the stock market. Again, anytime that the green bars, which represent the general stock market as measured by the value line standard edition average of the companies it's the average forecast. Anytime that is below the blue line, that probably means you can find a few things on sale. The farther it gets from the blue line, the more things that are on sale. And the opposite is true when obviously when the green bars are above the blue line. The two zigs and zag dotted graphics are the return forecast over time. And again, these are quarterly entries for the manifest investing projected annual return. That's an average of all the companies we cover. That's the red one. The golden one is the value line median appreciation projection. So again, it's just a way to look at the market. It's a long way to say the average stock right now has a return forecast of 9 or 10%. All right. Anything else, sir?
Nope. You did a nice job. Let's keep moving.
Ken's in a hurry. We're going to have a round table tonight. All right. We are coming down the stretch here. We are literally within inches of the groundhog finish for this year. Ann Renly, who has been, I believe, in first place for the last few months, continues to hang on to the lead. Ken was remarking earlier that his percentage just keeps going up, but he's either floating or moving down the list slightly, but the percentage is up, so that's all good. But yeah, the numbers are going up appreciably, and you can see that Kim slipped down to third. Ginger Williams, I thought maybe she'd make quite a run at it, but Ardelyx is kind of holding everybody up there. So we're basically seeing Orange County, California, probably coming home with the group title this year. Space Coast down there from Florida in 35th. They didn't make their big aggressive run at the end unless something really magical happens here over the next 3 or 4 days. I am susceptible to bribes in the form of Portillo's gift certificates, but no, I'm kidding. I'm kidding, everyone. But Ken, what do you see here?
Well, I'm going to do a study, Mark, and I'm going to wait till the contest closes and then ask you for a printout here, and I can compare it against what's on the online thing. But I listened at length today to a debate between two people on CNBC about whether or not an average investor could beat the S&P without owning any of the 7 stocks that have been tagged with the Magnificent Seven tag. And I'd like to find out if we have any portfolios in the Groundhog contest that have beaten the S&P 500, and it looks like they're running at 19.2% right now, if I'm reading that chart correctly on the right.
At the S&P 500, yes.
Yeah, so I'd like to just go through these, and I can do it very quickly by hand because there's not that many of them, I don't think. But I'd like to find out if any of these portfolios are doing that without containing one of those 7 stocks. So I'll have that to report either at the next roundtable or the one after it, depending on how quickly we're able to close down some of the figures for the contest. But I think was a very interesting conversation. The one gentleman who's the moderator indicated that it couldn't be done. And so that's what kind of brought the challenge to mind that maybe it could words. Be, yeah, exactly. So the woman that he was arguing against said that was, she used pretty strong language, basically saying that was a ridiculous argument. And she was certain it could be done. And I'd like to just find a couple of portfolios that have actually done it. That's all.
All right. Well, that's not a big job. I'll clip out that part of the spreadsheet and send it to you. I am certain you're going to find quite a few. Here's a fun fact for you, though. If you look at the number of equity, well, we'll just say fund, whether it's mutual fund or exchange traded funds at Y charts, and they can invest in anything, right? So we're talking about being able to invest in anything. There's about 69,000 funds, which is just staggering to me. And if you look at the number of funds that actually beat the market this year, the percentage is 7%.
Wow. Now that's funds and ETFs, right, Mark?
That's right. And being able to invest in anything. So we're going to expand on that, obviously, as we talk about the Groundhog results, because there's a lot more than 7. You can see it's 30% on here. 30% of the participants have beaten the market versus 7 from that other group. So it'll be kind of interesting to take a look at. And we'll have some fun. So I will make note of that, Ken, and everybody good luck as you ring into your final positions. I will be scouring that number 4 position carefully to see if there's any mathematical errors that would be in my favor. Um, stranger things have happened, but this year was dominated by our Delics. That's what the performance perspective is all about there. You can see uh, the various performances since last Groundhog Day of all those different classes, and many of the Mag 7 are right there, Ken. And just some really nice stuff in the middle of that chart. And again, our nemesis, the miscreant Clearfield for the last year, really damaged a lot of portfolios in the
And
Groundhog.
I'm getting a message from one of the folks in our audience. Sandy Castor is telling me that she's beating without any of the Magnificent Seven. I
Okay,
don't see her on the top 40, but oh no, there she is in
18th.
place.
Yeah.
Okay, 18th place. So I have one already on the list, Mark, that's beating. Okay.
Oh, I'll bet you there's a bunch. Yeah, there's a bunch on that page right there. Good
Okay.
stuff. All right. Good luck, everybody, to finish up. Here's the invitation. Any of you that are not familiar with it, we've been doing it now for 18 years. Um, the summary of the rules of engagement are there on the left, but basically it's pick some stocks, a minimum of 5, a maximum of 20. Full disclosure, you don't win very often with 20. If you're better off going for it on the other end of that spectrum has been our experience. There are exceptions. Space Coast Florida won with 20 picks last year, Ken. So it has been done. It's just less likely based on our experience looking in the rearview mirror.
Yeah, our contest was won by a 15 stock portfolio, and that's the first time that a portfolio of more than 8 stocks had ever won our contest. So it does happen occasionally, but usually the 5, 6, 7, 8 is the size of the portfolio that's winning these contests.
And the other thing that was kind of unusual is usually if it's kind of a weird, if the year has a weird feel to it, and last year kind of qualified a little bit, we often see many more of those celebrities that are in italics bubbling to the top of the list, and they did not do that this year. They're pretty much all off the list, and we are proud to say that John Kimmel out of Wichita, and some of his people may actually be on the call, are he's making a pretty good run at it again this year. We'll take away the celebrity uh, trophy this year. All right, so we'll get those
Maybe
accounts
that,
to work.
Mark, maybe that gives some credence to all the work that you've talked about in indicating that a lot of managers manage for the negative rather than manage for the positive. Uh, we did have a pretty dismal year last year, and maybe if you're managing for the negative, that's where you shine.
Yeah, and it really does come down to our results, which we'll go over next week, are pretty spectacular over the last several years, and it really comes down to buying better companies when they're on sale.
Yep,
It's
absolutely.
not terribly complicated once you figure out how to lick your finger and hold it up in the wind and figure out what's going on with the company that you're taking a look at. All right. Here's a quick note that came right after last week's session because we had talked about how if you go after some of the earlier stage companies, the companies that Ken generally likes to avoid until they've got a little bit more of an established track record, but when they disappoint, they just get massacred. And this is actually a massacre on a fairly large scale. And it illustrates the point perfectly. You basically had Roku coming along and basically reaching that point where earnings go positive. Everybody is filled with euphoria. Ken, I think the price to hope ratio was pretty high right here.
Yeah, it absolutely was.
And then the point to be made is that it basically reversed and went back. And when that happens, it just frightens the rhinos. It frightens many people. And you can see that this ended up being quite a spectacular drop in price. So you have to be prepared for that. You have to perhaps put in measures to detect and avoid this if that's the type of investing you want to be doing. Either that or you have to have steely resolve to ignore these things. And that I would argue that it's not easy to ignore a 92% drop in stock price.
Mark, if you're looking for another example, you might explore iRobot. uh, Amazon just pulled their
Oh
uh,
no.
yeah, just pulled the rug out from underneath the merger. So Amazon has indicated it's no longer interested in purchasing iRobot, and that stock is languishing now, and it's had a pretty bumpy history to it. It used to be a favorite of many people in our own community for a while.
Well, I'm sure I picked it for best small companies a few years ago, so
Yeah.
probably got disappointed. So anyhow, this is just to illustrate how stark the disappointment can be in a situation like this. So okay. All right, let's go on to another piece of correspondence, and we just love getting questions like this. This happens to be from an investment club that's trying to come to grips with what they see happening at Forward Air, and there is some confusion. You're not the only ones. We're not the only ones. The analysts are also a bit confused. So apparently is the C-suite at the subject company. But a question came in. We had talked a few weeks ago about a problem that we discovered with Clearfield. And yeah, the Clearfield has some fairly special challenges. This one is perhaps similar, but Clearfield was more of a situation where you only had two or three analysts following the company, providing the analyst estimates. And when they changed their minds suddenly, you basically had a huge amount of turbulence created in the analysis of the company. So that we actually walked through that. This one's a little bit different. And we talked about it briefly last week during the session. This is a case of a merger, or Ken, I don't think I'm wrong about this. The company that they're acquiring is actually larger than Forward Air.
I would say it's fair that they're pretty equal in size, Mark.
Pretty equal,
But
so it's a merger
but
of equals.
technically, I think it is a little bit larger, but I think they're fairly equal in size.
So anyhow, it's definitely a combination of consequence. It's not like a company with 900 million in sales acquiring a company with 20 million in sales. That's not going to do a whole lot. We're talking about an equal amount of revenue, and in fact, the pro forma numbers, I've not seen them yet. If they're actually out, it's a interesting situation. There's also some more turbulence, and I'm sugarcoating as far as how the merger was proposed and went down. Um, there's a lot of people confused and some downright upset. So that actually permeates the analyst community a little bit too. So the question basically is, it seems like they've got some serious issues going on with their fundamental results. The earnings stability is still 89 on manifest. We'll take a little bit of a look at that. And let's just kind of go through. I mean, here's a look at the situation. The stock price has taken quite a dive here, and the expectations you can see are a little bit diminished. Now, keep in mind, this is Forward Air only. It does not reflect the combination company. So it looks like a fairly steady expectation, but it is somewhat lower. When it comes to the earnings per share stability, the thing you want to keep in mind is that at Manifest, we embed some of those forward estimates, and we're basically looking at the variations in this number here, up and down, and we basically stack that up versus the entire universe of companies. In other words, how much deviation or volatility is there in that number, and how does it compare to the universe of companies? So what has gone on so far has not really disturbed that too much. We'll take a closer look in a minute. As far as the current label on the website, it really is referring to our audit cycle, not so much the update cycle, but the audit cycle. And in fact, our most recent discussion on Forward Air resulted in an audit, literally just a couple weeks ago, and that really is what that designation refers to. The time when we actually sat down and scoured the numbers and double checked and confirmed everything. And we do that on a quarterly basis for the value line companies. We'll talk about that in a minute too. Anything else here,
Mark,
Ken?
our information guru out in the audience, Len Douglas, has let us know that the audience might want to know that Omni, which was the acquired company, is not a publicly held company. So there's not a whole lot of data available for the company that can be resourced to help you with some of the issues that are involved with the merger. It's a private company that Forward Air was buying, or
Yeah,
is buying, or did buy.
until they release some stuff, some information, it's kind of hard to even have expectations for the combination company. And that's what we're talking about here. Just to be clear, you're looking at a stock selection guide visual analysis for Forward Air on the left-hand side. And yeah, there's been some pretty good turbulence. That's not by itself all that unusual. I mean, you can see historically there has been ups and downs. This is a zig and zag type company with the business they're in. They're going to be sensitive to economic disruptions. We certainly had that in 2021, and then a little bit of an overshoot and just some probably some snapback if you want to think of it that way with what's going on in 2022 and 2023, but also some confusion. And you can see that the analysts have injected their numbers. Well, actually, I had to input these. If you look at the detailed estimates at Better Investing, and correct me if I'm wrong, Ken, I think they probably were shut down when the merger was announced because there's no estimates, no detailed estimates
There's
available there.
there's no rhyme or reason, Mark, why some of the companies in the database at Better Investing have Morningstar estimates and some don't. And Morningstar doesn't provide any reason for why it does on some and doesn't on others. So it's just, all we need to understand is that a majority of the companies do have estimates, but they're not readily available for every single company. And that's as far as we can go with why it happens that way.
Yeah, and it's not just confined to Morningstar, Merrill Lynch or pick any name. A lot of times when they run into a situation like this, they will simply call a timeout and discontinue coverage. I see it every morning when I wake up and they have discontinued coverage on a company, and our numbers all get blown up by that. So the numbers that you see here, I put them in. They're value line numbers, and value line struggles a little bit with companies like this. I'll show you what I mean by that in just a minute. On the right-hand side is the analyst consensus numbers. You can see that 3 or 4 analysts are covering this company. So again, relatively small number. This is number Ken. I think you wanted to point out that these are 22 actuals.
Yeah, that's the number that threw me in trying to read that chart on top there. So that's the 22 actual earnings per share number, and then the analyst estimates are next to it. You can see the huge decline in what the estimates are going to be, a 40% plus decline in the estimates for 2023. Value Line also makes a real big deal about the fact that until the mergers are successfully completed, Value Line will refrain from adding any of the numbers of the new merger, the new company, into their analysis. So these numbers are coming from a value line on 11/17 that's prior to the completion of the merger, and therefore these numbers are reflecting Value Line's opinion about just Forward Air prior to the merger. That's kind of confusing, and the next value line should have numbers that reflect the merger, providing the company has been able to provide enough information at that point to the analysts.
Yeah, and again, this is one of our favorites for over the long term. So we'll be interested in how the combination company looks. Everything on the screen is think of it as the old company, the existing component that is Forward Air. So that was challenged. And then, as Ken said, this is probably the best idea when looking at this company. If I own it, I probably sit on it and wait till the smoke clears. If I'm thinking about buying it, I wait until I have some image of what the combination of Omni and Forward Air looks like going forward. All right. I just wanted to throw this one up again. Anytime we are talking about a sales growth forecast, we're talking about this dotted red line. And literally, we're looking at, in this case, the representative old company over a period of many years delivering that return forecast, call it 10%, whatever the number is. A case could be made that basically every year of actual data pretty much lands on that trend line. You can see a bit of a bubble up here above the line. These are post-COVID effects that happened. And then here's the snapback. That's probably foreseeable in most cases. And here's what happened with the snapback down here. And that's the real problem. Going forward, if it's me doing the analysis, I probably would not be surprised to see them hit the lines again, maybe on the low side. But the point is, the earnings predictability, again, that's based on the actual volatility in this range. Keep in mind that our earnings per share stability includes this stuff out here also as part of the calculation. That's why it's slightly higher, it's steadier. It reflects a little bit steadier situation. All right.
I would suggest, Mark, that a good search of the internet will turn up some pretty interesting articles about the way different people feel about this merger. There's a lot of feeling that Forward Air is stepping out of its comfort zone and trying to change its business model, because this company, Omni Logistics, does not do the same thing that Forward Air actually does. Without getting any more technical than that, I would suggest if you're really interested in the company, that you go out there and search for a little bit of the dialogue behind the debate about the merger itself. I think you'll get a little bit of eye-opening as to why there's a legitimate concern, and it doesn't only have to do with how big this company was and how much they paid for it. It has to do with whether or not Forward Air can step into this new business model and be successful.
Did you find any of it to be optimistic or affirmative, or is it all pretty much cautionary?
I found a lot of it is just cautionary right now, Mark, that nobody can really make a prediction as to whether it's going to work or not going to work. But it was enough of a cautionary tale that there's decidedly two different views, two different sides to the debate, and it's a legitimate debate. It's not a real emotional debate. It's fairly legitimate. So, and you can find the write-ups fairly easily by doing a news search on the internet. Just be a little bit creative when you put in your search terms, and you'll be able to deal with it.
Okay. All right. So leaving the Forward Air discussion a little bit, just to put a finer point on some of the stuff that the club was curious about. They're just basically asking the questions: are the prices updated daily, and would that change the return forecast? Absolutely. Every day about 8 o'clock, the prices change. Every once in a while, we get a glitch where the data feed will hiccup a bit. But yeah, the return forecast will change anytime that's the case. Sometimes it doesn't change it enough to even move it at 0.1%, obviously. That's the case most of the time. But it is changing whether you can see it or not. Do we get our data feed from Morningstar? No, we don't. We get it from YCharts. Now, YChart does have some Morningstar data embedded, so there will be some of that data, but no, it comes from YCharts. Do we get daily updates from YCharts? Yes. Fundamental data, it's literally continuously. So the companies are updating every day, virtually continuously. And it's kind of a replication process. So yeah, the companies that are affected are those that changed. So any change in a company is going to trigger, and if it's big enough, it will actually trigger a change in the top level reporting that we do. When there are no detailed estimates, does that mean that Morningstar slash Finance Yahoo slash YCharts does not have an analyst following the stock? Not necessarily. As Ken said just a few minutes ago, sometimes we can't even figure out why there isn't coverage. But keep in mind that Y charts operates from an analyst consensus, so often they'll have, especially for a widely covered company, they might have 60, 80, 90 analysts for some of those. Some of the companies are obviously down in the single digits, low single digits in some cases. And again, as we said earlier, most of the research entities will often suspend coverage when a significant event like what we're witnessing and scratching our heads over at Forward Air. What's the date that's listed in under the alert feature? This is what we were pointing to just a minute ago. This is literally reflecting the time that we have actually gone in and audited and made sure that we're trying to be as representative as possible with the company. And the other thing that Ken and I were talking about last week that still remains true, every once in a while, the analysts do strange things. In some cases, they use placeholders. You think I'm making this up. Like they'll take the number from last year's sales total, add a penny to it, and that's just their reminder that they still have work to do. And that ends up getting out there into the averages. It's just wild. So again, at this time of year, the actuals and the forecasts are just kind of bubbling into place. It'll take a few weeks, but we're trying to detect and address that in any case. So.
Yeah, we've had access to Morningstar analysts and to Value Line analysts at our conventions, and it's amazing to listen to them and to have them tell you how many companies they actually are responsible for updating. I mean, sometimes it's easy to get the idea they're only looking at 2 or 3 companies, but in fact, that's not anywhere close to being true. They're looking at more companies than we can even imagine, and trying to keep all those facts and figures differentiated and to make sure you fill in all the proper blanks and anything becomes quite a feat. I think that there is not a single data source anywhere, and that includes any data source you want to name, that doesn't contain errors. We just have to be aware of that. And when we find an error, we don't get angry. We should just be pointing it out to the people that can do something about changing and fixing the error. That's all.
I would say that Value Line is nearly perfect, but I run into an obvious error or misprint 1 or 2 times a week. But for the volume of stuff that they touch, it's really good. But I run into them, and if they're egregious enough, I will report them. On that subject, Matt actually uncovered that the earnings for, help me, Matt, what company was it we were looking at? Actually, were reported wrong. Was it Western Alliance?
Oh, yeah, it was, no.
No, not Western Alliance.
Yeah, they were confusing the GAAP and non-GAAP numbers. They had them reversed. I
Yeah,
think it was.
and Reuters actually issued it in error, correct?
Yeah, I thought it might have been my broker or some other downstream thing, and I started seeing it seeing the same error multiple places and traced it back to Reuters.
So there's just an example of trust but verify, in my opinion, Matt. They reported $1.33 versus $1.88 expected when the real number was $1.91 versus
Right.
$1.88. That's a bit different. I would call that almost material. So
They still
again,
exist. It's been almost a year and they still exist. It's a win.
it's it's a matter of be careful out there always. Um, is there any correlation between the new value line update and the Morningstar update? I don't know how to answer that. Sorry. You guys do not do any data manipulation. You get a data feed and it populates your database. Is that correct? Predominantly, yes. But we are always on the vanguard. We're watching for companies where the company changes. So when you've got a merger or a divestiture or the capital structure changes or whatever, again, keep in mind that when you're doing a stock study, your objective is to understand the company and imagine what that company might look like 5 to 10 years out. So you have to be dealing with the data, which is representative of that as you're trying to do your extrapolations and everything else. So again, as you imagine the company, you basically have to be looking at only the historical data that is relevant and appropriate for what you're trying to do. So, Ken, did I explain that badly, or?
It's as good of an explanation as I've heard, Mark. So let's just dealing with data is tricky. It becomes very technical sometimes. We've tried to explain data at Better Investing by bringing in our chief of the data project, which is Susie Archberger, and she's done ticker talks on it. And sometimes there are things that are almost unexplainable. Sometimes we have to just trust the data when it comes across and see if it's corrected. We might have a hunch it has problems, but the next time it comes through, we'll have to see if they change it or if they keep it the same. Again, I don't think there's any data source that's 100% reliable, and I agree with Mark that Value Line is probably the most reliable, and I think followed very closely by the print version of Morningstar. That's the version that you find when you go to the web or you go to the library to find it. Remember that Morningstar is selling data to Better Investing, which is then taking that data and putting it in the proper place in the SSG Plus. That's all those places. There's always room for a data problem to happen.
So we're always out there watching for that. So again, here's the key statement: as you're looking at historical data and projections, you want to be building that image in your head of, what does this look like as a continuing operation? And so for example, when Pfizer merged with a company almost the same size as Pfizer, you have to basically disregard the historical data up to the point of the merger. So that's the only data, and I'm using air quotes, manipulation that we do. You have to select the data which actually applies to the continuing operations. All right, and last but not least, if there are no estimates, where do we get the sales growth forecast and EPS estimates? Well, first of all, we never use estimates from third parties when it comes to at least one of those two characteristics. And the sales growth forecast is always calculated by the computer based on that red dotted line. And the earnings per share estimates are always based on a version of the preferred procedure. The same thing that we do all the time during our stock studies. So any embellishments or clarifications on that, Ken?
No, I think it's a very set of technical questions. Again, I urge you to strike the word M-star from the fourth paragraph on down, because everything that Manifest does uses Y charts, not Morningstar. But other than that, I think we've covered the subject as well as it can be covered.
Okay, so let's press on with Buttonwood. All right, this is that real money portfolio that we've been taking care of. We seeded it with $2,500. We're going to add $100 every month and just basically build out a portfolio and demonstrate that it can be done pretty cost effectively. So this is the status of the portfolio. As of last week, we added Axcelis Technologies, tickers ACLS, and it's backed up a little bit, but not bad. And Visa was a gift. They stuck in our portfolio, so we do have a little bit of cash to spend. So I asked Ken a dangerous question. I asked Ken what he was interested in. So I'm going to show you a little bit. We'll actually go live to this in a minute. Many of you probably aren't even aware of this. If you're in an investment club, I know that Ken's clubs all use this. There's actually a zone, we call it a sandbox, where you can play with portfolios that are related. So I created a FAUX, that's FAUX club, for our Buttonwood experiment, just to demonstrate the fact that you can actually store things like industry studies or watch lists. You can see that Dean and Annette actually submitted some entries last week, so they're here too. But if you want to take a look at this, I'd be happy to send you a quick note. All you do, send me a note saying, I wonder if this might not be something that would help get our club on more of a common ground when it comes to this type of stuff. It's all private. Only the members of your investment club can access it, and it's a way to go. So in this case, I built out a portfolio of his response to my dangerous question. Here's what it looks like, Ken. What do you like here?
Mark said, what stock singular, would you want to add to the Buttonwood portfolio? And I answered him with a group of 11. I am in the process right now of taking required minimum distributions, and I'm in the process then of turning that cash back into stocks that I want to own in my after-tax portfolio. Some of the money is going to stay in fixed income, but some of it I want to turn into growth. So I need a list of candidates, and I've whittled that list from about 25. I started working on this list back in mid-November, and I've whittled the list from 25 down to these 11. And I only want to buy 3 or 4 stocks when it's all finished, when it's all said and done, because I can't follow 40 different stocks in a single portfolio. I don't have the time or the inclination. So I'm selling 2 stocks from my portfolio, and I'm going to replace it with 2, maybe 3 stocks. And here's the list right now. Mark, if you want to help me winnow it down, we can. There's big stocks on this list, there's medium stocks on this list, and there's small stocks on this list.
We can take a look at a worksheet here in a minute. I'm just curious in your general thoughts overall on CVS. It's been...
I think CVS has made the list for a couple of reasons. First of all, the yield. I'm getting older, and yield is becoming more and more important to me in my portfolio because I am leaning towards a portfolio that isn't making an attempt to beat the market by 9 or 10 points, but rather is making an attempt to stay ahead of the market by 2 or 3 points. In other words, I'm leaning towards, in my mind at least, a little bit safer portfolio. Now, I probably could enter into a debate with anybody about whether CVS is a safe stock or not, but safer a lot of times means that some of your appreciation is coming from yield. So that's one of the reasons CVS is still on the list. And then that par value over to the right is extremely enticing. That's a wonderful, wonderful par value for a very, very, very large, diversified company. CVS is not your grandfather's drugstore anymore. CVS has all kinds of other businesses that they've purchased and made a part of the company, including an insurance firm and a healthcare firm and some other related kinds of things to go with the old drugstore. Some of the experiments that they've tried haven't been as successful as others, but CVS is still a thriving brand with lots of places to access the company throughout the land, and they still do fairly decent business. The growth is pretty decent for a very large company. 8% growth in a large company is not anything to sneeze at. I would expect a company this size maybe to be growing closer to 5 or 6%, and to be growing at 8% at the size it is, I think says that they have pretty decent management and a pretty decent idea of where they want to go. So those are the things that attracted me. And then I think that 11 PE mark is just the cherry on the cake.
Yeah, I mean, that's the one that kind of jumped off the list at me because, well, first of all, every other company on here, maybe with one exception, is in the Round Table tracking portfolio or best small companies. Even EXLS is in best small companies for this year. And a number of the other ones have been.
Would the exceptions be Malibu Boats?
Well, Malibu
because
has
in my mind, that's an exception as well.
Yeah, and they're suffering through economic turbulence for sure. But they have been featured by us. Charlene has featured them a couple of times. Pretty sure they're still in the Round Table tracking portfolio. So this is one that has caused a little bit of heartburn and disappointment. I mean, I have a number of letters talking about, why has not CVS delivered? I would just encourage everybody, every time I go to CVS and I see that huge wall of envelopes full of prescriptions, I'm just baffled. I mean, it's just a huge demand, and obviously the battle with Walgreen. Uh, you can, when you compare the two side by side, it's clearly a battle, and CVS is winning, even if they are, I don't know, dare I say they're coming out of it looking a little bit like Ukraine. I don't know. It's well, maybe Walgreens is the Ukraine side of that equation. Um,
Well, I will tell you, Mark, that Malibu is on this list as a turnaround play.
oh, definitely.
Uh, I have to convince my wife that we might want to take a little bit of a jump on a turnaround play. She's very resistant to companies like this, and I don't hold a lot of hope that it's going to end up being one of the top three, but I felt that it was necessary to put it on the list because I have such faith in it. Maybe the other one you're speaking out is United Health Group down at the bottom. I don't know. But
Mm,
it's on the list for basically the same reasons that CVS is on the list.
hmm.
Again, for a huge company, the numbers, the growth numbers, the PAR numbers are superb for a very large company. And again, it's paying a dividend that's fairly decent for the market that we're in. When you get dividends up around 2%, that's a pretty decent dividend in today's market.
Yeah, and I would just simply observe. I know the company quite well. My sister used to work for them. Um, that's not an accident when a company achieves that level. So
Yep.
quite a bit of quality. So let's take a look at. Here's one of the ways that you can work on whittling within an investment club. Again, we're talking about a private work area called the worksheet. If you hit that little button there at the top, this pull down menu comes, click on worksheet, you're presented with this option. And this is literally a what if option. As you go down the list, like I set aside ASML simply because we recently put ACLS in the portfolio. So as another chip related stock, just said, well, why don't we sit that one down there and just kind of whittle. I would probably join Natalie in the debate, on, okay, let's talk through why that turnaround. I'd probably send Malibu down here. But these are sorted, I believe, by highest quality. So I would literally
I
be
was I
working.
was interested in why you put Tractor Supply down at the bottom. So at the beginning here, Mark.
Probably fat fingered it. I don't know. I had no specific
Okay,
reason for putting it down there other than to demonstrate.
okay,
And
okay. Just
we'll
demonstration. All
demonstrate
right.
it live. But this is literally the type of worksheet that I would go through even on my own individual portfolio dashboards, um, just whittling down the list. All right. So with that, let's close with some comments and then we'll demonstrate. Just here's a quick look at the company, United Health, and current price is 500. Sounds expensive, Ken.
Well, I don't. You don't measure
Oh,
expensive by
it's
how many dollars per share. You
kind of a
measure
trick question.
expensive by, I know it is, by valuation and by par and everything else. And I think this one, frankly, is I don't want to say it's on sale, but it's close to being on sale. It's not like a friends and family sale where they're giving you 40 or 50% off, but it certainly is on one of those 10% off or 20% off sales. It's fallen a lot in the last week and a half in sympathy with Humana.
Yes.
And if you study Humana, you'll find that Humana has announced that it's having some pretty serious problems with medical costs, moving faster than they can deal with some of the medical costs and cutting into their profit margins. Because United Health seems to be much, much, much more diversified. Uh, Here's a bulletin, folks. In the roundtable tonight, I'm going to do a complete analysis of United Health. You might want to come if you're interested in the company. That's tonight roundtable, 8:30 Eastern time. But United Health seems to have fallen in price right along with Humana, but they're not at all as similar as people might expect
Right.
them to
Right.
be because they both do some of the same things.
Yeah, and I can save you the 20 minutes from tonight. What Ken is basically going to tell you is that the company is trading pretty close to its multi-year high return forecast. And it never gets terribly sexy, but when it gets up in here, it's probably worth paying some attention to historically. And it's been a steady company. Here's a look at how steady. I mean, operating margins are basically very reliable. So are the bottom line net margins. PEs are very steady. You can argue for anything in the high teens here. Company is trading down close to its 52-week low. Decent debt, not too bad. Morningstar says it's on sale, so do the analyst consensus. So it'll be interesting. We'll see how
I'll
Ken
tell
makes
you
the case.
one of the numbers, Mark, that helps me be very optimistic about that company is that blue bar in 2027 under operating margin.
Absolutely.
Now Value Line has a great deal of difficulty sometimes with small emerging companies, but Value Line tends to do one wonderful job when it comes to large established companies. And if Value Line is making this call for margin expansion like that, then they have some real reasoning behind it. Some of the things I've read have given me some ideas about why that margin's going to expand, but Value Line just puts a number to it, and that number is a lot higher than it's been in the last 10, 15 years. So I'm very surprised by that number. I'm glad that the net margin number bears it out. That's the red bar in 2027. And I'm glad to see that with that does not appear to be an expanding PE to join it. They're calling PE value just to stay fairly nice, consistent at maybe 17, 18, 19, somewhere in that range.
Mm-hmm.
So I'm very, very happy with the analysis done by Value Line and with the analysis that I've done myself then.
All right, good stuff. Here's a look at the price chart, and this is kind of the other side of things because the fundamentals have been continuously improving. And again, we talk about this all the time. You see this type of a flat channel. Again, here's one from the not too distant past, just a few years ago. And sometimes these companies will trade in that type of trading range for some period of time. And when they break out, it can be quite a pleasant situation. Home Depot is kind of the poster child for this. They would trade in that range for literally years and then bust out and do great things. The other thing is the relative strength index doesn't get anywhere near 30. If you're waiting for 30, you're going to wait for a while. So it's down there now. It's a very interesting call for tonight's roundtable for sure.
Mark, Dwight is asking a question about whether or not there are YouTube videos or publications where he can review manifest methodology. Is there anything that you could refer him to at the moment that you know of?
We've got a number of times when we've talked about the forecast methodology and the various components of quality and that sort of thing. So I could collect up and post it in the forum, just 2 or 3 or 4 of the better summaries that I would look at. So I'll do that.
That's Dwight Kunkel, Mark.
Okay. All right. Anything else?
No, we're staying up to date here.
Okay, so here is just your reminder that we do put these sessions on YouTube under Manifest Investing. You can see that we put roundtables, we put our educational sessions. You can still see the Getting Started series at the front of that pack, along with our bull sessions. Your reminder for tonight's session, a little artwork again.
This is a good one. You get a good one every once in a while. This is a really good one. Okay.
Yeah, that's a very proud, noble groundhog there.
Yeah, I like that. Okay.
All right, so what I thought we would do, if it's okay with you, Ken, is just demonstrate that real quickly.
Sure enough.
So literally, I will try to go to Manifest. All right, I'll increase this a little bit so that people can see okay. Is that generally okay, Ken?
You can go even bigger if you want, Mark.
Go big or go home. All right, so
that's good. That's good, Mark. Yeah.
All right, so what we're talking about is you go into it could be your own dashboards. You can see, oh, there's some private stuff there. Go into the club if you're a member of a club. And again, just the partners in your club will actually be able to see this. So here's that buttonwood portfolio. Here's that list of candidates that we were just putting up there. And this is the stuff that Ken has brought. And if you click on this tab, pull down this worksheet menu, you're actually taken to that play area. Now I was doing some playing around, so let's go ahead and reset. That'll bring everything up to current.
Yeah, and I use this quite a bit, and I would suggest that you always start with a reset. Yeah,
Yeah,
unless you
unless
left in the middle of a session. Yeah,
unless you have a reason for not doing it, because it's
yeah.
basically bringing all information current. And like we were saying, so if he and I are sitting down and talking about the strategy of whittling down this list, my reason for I love the company. It's a great study, ASML. I also like Taiwan, but we already have the ACLS in there, so you can actually click on this green arrow. X gets rid of it. The green arrow puts it down in purgatory and just basically takes it out of the picture. If it's an actual portfolio, it would actually correct for the calculations. And the other one that we were sitting down there, again, I would probably again, you can do the same type of thing, sort by quality. Hey, how about that? Monster Beverage coming up at the top on the quality sort, Ken. Wonder who's presenting Monster tonight. Um,
I think I know. Okay.
so this actually becomes an area where you can play what if games. And basically created the portfolio by uh, putting $100 into each of them so we could compare them over time. You can see the Tractor Supply's actually come down in the last couple of days since Ken gave me the list. Um, it just becomes a very effective way to tinker with this kind of stuff. You're never going to sell Natalie on Semler yet, so let's put Semler down there.
You're right, and I'm never going to sell her on Malibu boats either, Mark. So
Okay, so
you
we'll
can
put
put it
Malibu
down
down there. So
there.
again, what you see happening here is these are just being set aside. By the way, if this were a real portfolio, the cash is correcting because these are moving down here and it's basically treating it as a proceeds of sale situation. So then you can do what ifs, adding other companies, that sort of thing. So
Yeah, I'll tell you where I would sort next, Mark, and I would sort in that growth column next because both Natalie and I are very aware that sales growth is very, very important to a portfolio. Um, I might have convinced her enough about Shockwave that that's going to end up being one of the ones that we put in. She has a very small holding of Shockwave already in her IRA, and so we're looking to put something in our after-tax portfolio. And so Shockwave might very well make the cut.
yeah, and Shockwave is going to be the type of company don't believe I would consider Shockwave to be core.
Oh, absolutely not. Right. But
So it's sitting
our
there.
after-tax portfolio has no non-core companies in it at the
Mhm.
moment. And we're old enough that we can afford to do a little bit of messing around in our old age. So, it's maybe there's other kind of messing around you don't do quite as often, but you
Hey,
can do this messing around.
too much information. Be careful. Okay. So anyhow, this just gives you an idea that you can do this sort of tinkering and debating, and I've seen a number of clubs actually use this as taking the existing dashboard, the existing club portfolio, and say, well, what if we sell these companies and replace them with these companies? Here's the before, here's the after, and it becomes part of the proposal to the partners of the club. So
Yeah, our
all
BI
interesting
Baker
things.
Club, Mark, has this capability, and we've had a death and a resignation in the club in the last month and a half, and we're going to have to pay about $65,000 to these two accounts to pay it out. And this worksheet has been extremely helpful, not only in focusing us on what we should sell by sorting it by par, I mean, it's a lot easier to sell something that has a potential going forward of 1 or 2% than it is to sell something with a potential of 19 or 20%.
Mm-hmm.
But it also focuses on the growth of the company. You know, we've always cautioned folks about getting rid of really high growth companies too quickly. And there is no really slow grower on this particular list, but on the Baker list, we discovered a company that over time is now the growth expected to be down around 2 or 3%,
Mm-hmm.
and that gives us a really good reason for selling it too. We always double check with what we're doing with Manifest. We cross check it against our SSGs. There are times when our SSGs don't agree with Manifest, and if we could figure out why that's happening, then that's okay. And there are times when, in fact, we're going with our idea rather than some of the data coming from Y-Charts. We find that when Y-Charts only has 1 or 2 analysts following a company, and Mark's in complete agreement with what I'm going to say, when they only have 1 or 2 analysts covering a company, Y-Charts can be as fickle as any other source for helping you decide where it's going to be, you know.
All right. So the worksheets, play with them. If you want access or have a club that might be interested, let me know. All right. So with that, Ken, I think we can go ahead and put up our groundhogs again. Invite everybody for tonight's session.
Cheryl is asking a question. Do we have clubs that play with these worksheets in real time during meetings? Absolutely, Cheryl, especially when the portfolios get to be a little bit larger and you're dealing with larger sums of money, and you might have 2 or 3 stocks in the buy zone that you like and that all could be considered. You have goals for your portfolio, and sometimes playing with a worksheet helps to deal with those goals. We're getting our audience saying, yes, we use them all the time. A nice question from Sharon Sarah says, did you say members have the ability to set up a worksheet? Sharon, individual members have the ability to set up a worksheet. You can, of course, display that on a computer and then display it in front of the club. Mark is showing you a service that he will provide to the club to allow them to not only have a separate space to store things that are directly pertaining to the club, but then to be able to share a particular a worksheet when you're not at a meeting where you can actually project it. This allows the club member all the club members at any given time to look at that sheet and to manipulate it if they want to. So there's all kinds of things that can be done.
So I'm real time doing it with the Buttonwood portfolio. We forgot to do a poll, Ken. Do you want to pull up the poll and get a vote?
Sure.
On
let's on Monster Beverage? Is that what you're looking for, Mark? Or
no, United Healthcare.
United Healthcare. Okay. So yeah, let me see if I can get the poll open right here. Polls. There we are. So would you like to put United Healthcare in the Buttonwood portfolio or pass on it and wait until the next selection? We'll give you just a few moments to vote here. We're up to 40% voting already, 50% voting already, 60% voting, 70% voting, 80% voting. Come on, let's push that to 90 if we can, okay?
It's a very decisive group.
90% voting. Okay, I'm going to count backwards from 10 and then I'll close the poll.
Is it yes or no?
And I'm closing the poll, and it's a decided yes, Mark. Let's put United Healthcare in the portfolio, okay?
So
it's a good, high quality, large company, and we do want to see about a quarter of those in the Buttonwood portfolio when we're all put together.
Okay, I want to switch back to the screen. I will show you the actual effect of doing that using the worksheet.
Okay.
All right, so you should be able to see the actual portfolio. All I did is I went in and said, what if I added $162.50 worth of United Healthcare to this portfolio, came out of the cash. You can see the effect on the total portfolio. If you like what you've done, you save it to original and you're done. It's now in the
Uh,
portfolio.
Yeah, and let's take a look at the portfolio before we close things down, Mark. Our par right now is below my par. That means it's slightly below average. So the next 2 or 3 editions, we probably want to put par values that are up around this range in the 14, 15, 16, up to 19%. In that sweet spot, we probably want to add a couple companies that are in that range to move this par up. This is a very small portfolio. It'll be easy to move these numbers. Quality is wonderful. Growth is superb for a portfolio. If we could keep that growth around 12%, that's going to be great. We don't worry too much about PE ratio and yield at this point. Financial strength at 85 is wonderful. EPS at stability at 77, a little bit light, but really probably acceptable for any portfolio. So as we move forward, let's focus a little bit on par. And at the same time, let's try to keep our sales growth around 12, give or take a little tiny bit if we can. Maybe move out of what is occupying the pink section. What is? Oh, that's our
fun. Ignore it.
our fun. Ignore that. Yeah. Okay.
Yeah, we don't have
So
any need to ignore any particular sector yet.
no, pretty nice diversity. And I'll tell you, folks, there's usually never a time when you have to really ignore a sector. Pretty much the companies that you like tend to manage this kind of diversion itself. Let's look at the size diversion real quick, diversification real quick if we can. Mark, can you roll down just a little bit more? There we go.
It's split. It's basically
Yeah,
50-50
split between
between.
small and medium. Uh, United Healthcare is getting a call as a medium stock because of its sales growth. Remember that sales growth was around 9, I think, if I'm remembering correctly.
10.2. So
10.2. Okay, so that's being classed as a medium-sized company because that pie chart that you're looking at classifies by sales growth, not by amount of sales. So if it grows better than 15%, it's small. If it grows less than 7%, it's large. And if it grows 7 to 12, then it's medium. So, and by putting your cursor on it, you can see the 3 companies that are considered medium right now: Gentex, United Health, and Visa. And you wouldn't normally think of Visa as a medium-sized company, but the sales growth is what's important as far as Mark and I are concerned. And that sales growth of 12 point, what is it for Visa?
10.7. So it's
10.7 is
sweet.
certainly sweet for a large company like that, for a company that's has the sales that that company has.
So Ken, what I think I'm going to propose that we do is a week from today, we will have the most commonly chosen groundhog selections.
Oh,
And
that would be a great thing to look at.
I think
Yes.
maybe we sniff around those a little bit for companies that maybe fit the need of this portfolio.
My experience with dealing with clubs, Mark, is that there's a lot of what do you call it? I don't have the right word for it, Mark, but it's
Excellence,
it's
magnificence.
grabbing. No, it's people grabbing for companies that have already made their big move.
Well,
You know what I'm
speaking of that,
trying to
you had
say?
to be happy with Google's move here over the last few days.
Yes, I have been, but I'm wondering how many folks are going to have Ardelex in their portfolio, and do you think it has a
I
lot
can,
of movement left in it yet, Mark?
I well, I don't want to comment. I don't want to jinx myself. Actually,
Okay.
own shares of Ardelyx. Interestingly enough, Ken, there are probably 40 entries already in, and I think I have one Ardelyx mentioned.
Oh, that's wonderful. How about
Interesting.
NVIDIA? Are they picking NVIDIA big time?
No, but they are picking Taiwan and ASML.
Okay, all right. Great great companies, both of them. Yeah.
All right, we're running over a little bit, but I hope you guys enjoy this. Thanks for being here. We will be back online tonight, approximately 8:15, before the roundtable, and should be a good roundtable. Kim will be presenting PayPal. She's a real believer in a rebound there for that company. She's not alone. I'm going to bring Monster Beverage. Sai's going to bring InMode. The ticker symbol is INMD. If you want to do a little bit of advanced homework on that one, that has been a multiple roundtable selection, I believe, by you, Ken.
Yes. Uh-huh.
And Ken's going to give you the details of his United Health analysis this evening. All right. Anything else, sir?
Nope. Thank you, folks, for being here, and we'll see you tonight.
All right. Take care, everybody.